You move to Panama and keep your European clients, bill them in euros, and deposit them in a local bank. Your tax bill? Zero. 29 countries design their tax systems like this, where they only tax what you earn locally. Everything from abroad is yours to keep. Today we're walking you through all 29, explaining which ones exempt foreign income unconditionally, which ones tax it only when you bring it into the country, and which ones give you a multi-year holiday before any taxation kicks in, and how you can invest or move there tomorrow. Most developed nations, probably yours too, use residence-based taxation. That means you live in France, Germany, or the UK, and the government taxes your worldwide income. Doesn't matter where you earned it. If you're a tax resident, every dollar, euro, or pound gets reported. The US takes this one step further. Citizenship-based taxation means American citizens owe taxes to the IRS regardless of where they live, bank, or earn, even if you haven't set foot on American soil in a decade or work for an American company. For entrepreneurs, remote workers, retirees with investment income, and anyone earning across borders, worldwide taxation creates a relentless burden. Countries with territorial taxation only care about income generated within their borders. Foreign earnings remain completely outside their tax net. Before ranking these 29 countries, this info is just entertainment. Before considering any action, consult the experienced international advisors on imidaily.com. You can sort through 200 plus individuals on language, location, and programs they offer. Okay, you need to understand 4 distinct categories of favorable taxation. Pure territorial systems exempt foreign income unconditionally. Earn money overseas, keep it overseas, bring it home, spend it locally. None of that triggers taxation. 9 countries operate this way. Remittance-based systems only tax foreign income when you transfer it into the country. If you keep money offshore, it is untaxed locally. If you bring it in, however, you will owe tax on that income. 6 countries use this approach. Territorial systems with Carve-Outs have source-based taxation, but apply complex rules that can reclassify income as local. 12 countries fall within this framework, requiring the most careful planning. Holiday systems give you several years of tax exemption before partial or complete taxation begins. 2 countries offer this temporary territorial treatment. 9 countries, as we've just mentioned, offer unconditional foreign income exemption. These represent the cleanest tax planning environments. Panama leads this category for good reason. Local income faces progressive rates up to 25%, but foreign source income is completely untaxed. Even when you deposit funds in a Panamanian bank, spend them locally, or transfer them between accounts. Capital gains on foreign assets are also zero. The qualified investor visa provides immediate permanent residence through a qualifying investment of more than $300,000 US. After 5 years of continuous residency, you become eligible for citizenship. You can check out the video in the top right corner to hear directly from the Panamanian government why this golden visa is so appealing. Paraguay has a flat 10% rate on local income combined with zero tax on foreign earnings, one of the lowest territorial rates anywhere in the world. The SUACE Investor Permanent Residency Program requires company establishment with minimal capital rather than massive investment thresholds. But many people opt for the Independent Means Visa, which requires no investment at all. This is the America's most straightforward pathway for tax optimization. Costa Rica charges up to 25% on employment income and 30% on business profits earned locally. But foreign income is completely outside the tax base. Remote workers serving foreign clients generally have foreign source classification if they don't have any Costa Rican customers or operations. Moving to Asia, Hong Kong caps employment taxation at 17% under its standard rate system. Profits tax for sole proprietors sits at about 15%, but foreign income and capital gains both face zero taxation when properly structured. Source classification follows where you perform work, not where your clients sit or where payments originate. A consultant working from a Hong Kong office for overseas clients generates Hong Kong source income. The location of your desk matters more than the location of your customer. The Capital Investment Entrance Scheme, or CIES, requires 30 million Hong Kong dollars in eligible assets, which is about 3.8 million US dollars. Stocks, bonds, funds, and insurance policies qualify. Macau offers similar territorial treatment with lower barriers. Progressive employment rates reach only 12% at the top bracket, making it Asia's lowest top marginal rate among developed jurisdictions. Foreign income and capital gains also register at zero. The self-employed visa provides residence permits with considerably lower investment thresholds than Hong Kong's CIES. Other pure territorial options include Belize, Guatemala, Nicaragua. Bolivia also qualifies but has no investment migration program. Banking infrastructure and political stability vary considerably between all of these nations, but the aforementioned Panama, Costa Rica, Paraguay, Hong Kong, and Macau are the top-tier choices for most high-net-worth investors and entrepreneurs. 6 countries tax foreign income only when you receive it domestically, so timing of transfers is critical here. Singapore has progressive tax rates reaching 24% at the top. Foreign income faces those same rates, but only when funds hit a Singapore bank account. Keep money offshore, and it's untaxed. Recent changes under Section 10L now target certain foreign disposal gains, but the core remittance framework remains intact. Structured exits and timing strategies still work. The Entrepass program requires 10 million Singapore dollars, roughly 7.4 million US dollars, in business investments, approved funds, or family office structures. Permanent residence requires a valid re-entry permit renewed every 5 years. Malta stands alone as the only European Union member offering a non-domicile remittance treatment combined with full EU residency rights. Progressive tax brackets reach 35% at the top. Foreign income faces those same rates, but only upon remittance. Foreign capital gains are zero, even when you bring money into Malta. The standard non-domicile framework carries a €5,000 minimum annual tax, and the Global Residence Program requires €15,000 in minimum annual tax for 15% flat rate treatment on remitted foreign income. Mauritius offers the lowest remittance-based rate globally. A flat 15% applies to all income, including foreign earnings received domestically. Capital gains face zero taxation universally. The Mauritius permanent residency permit requires approximately $375,000 US dollars in qualifying real estate. Check out a few properties on IMI's revamped real estate platform, where all properties qualify their buyers for residency or citizenship. Gibraltar takes a different approach. Category 2 high net worth status caps your total annual tax liability at about £42,000, roughly $54,000, regardless of worldwide income. Authorities only tax the first £118,000 of assessable income. Everything above is taxed effectively at zero. Thailand and Ireland round out this category, though both present complications. Thailand restructured its remittance system in January 2024, eliminating deferral advantages. And if you don't qualify for Ireland's remittance regime, Ireland's rates reach 52% when you include social charges. Plus, the Immigrant Investor Program closed in 2023, leaving no investment pathway for new applicants. 12 countries have fundamentally territorial systems, but apply deeming rules that can pull foreign income into taxable categories. These require professional guidance. Again, seek support from the experts listed on IMIdaily.com. You can sort IMI pros by their location, programs, languages, and more. Georgia offers a flat 20% rate on local income with zero tax on properly classified foreign earnings. Work you physically perform in Georgia becomes Georgian source income, even with foreign clients paying from abroad. Digital nomads face particular risk here. Sitting in a Tbilisi cafe while billing overseas clients creates Georgian source income under standard interpretations of this law. El Salvador has aggressive incentive legislation reinforcing foreign income exemptions, but blanket assumptions about universal exemption really oversimplify the actual framework. Though the Freedom Passport program offers fast-track citizenship through direct payment of $1 million in Bitcoin or Tether, where you wouldn't even have to become a tax resident. Namibia has one of Africa's highest marginal rates at 37%. However, foreign income tax registers zero unless deemed Namibian source, and those deemed source provisions can be complex. Moreover, Honduras, Seychelles, Lebanon, Botswana, with its forthcoming Citizenship by Investment program, and Eswatini fall in this category. Each requires careful sourcing analysis rather than automatic territorial assumptions. Finally, 2 countries offer defined exemption periods before partial taxation begins. Uruguay provides a 10 to 11-year holiday on foreign income for new residents. During this period, foreign earnings face 0 taxation regardless of remittance patterns. After the holiday expires, though, foreign dividends and interests face 12% taxation, but consulting income, employment compensation, and business profits from foreign sources typically remain exempt even post-holiday. Proposed budget measures may raise these investment thresholds for new applicants, but the exemption structure itself survives for qualifying residents. The Dominican Republic offers semi-territorial treatment during initial residency years. Foreign financial income from investments and securities is taxable after 3 years of residency, so time-sensitive planning matters here. The investor visa provides immediate permanent residence in Dominican Republic with expedited citizenship pathways. We covered this path extensively in our video about how to stack 3 passports in just 6 years for free. You can watch that in the top right corner. So which of these systems makes sense for your situation? If you want unconditional foreign income exemption with established infrastructure, Panama and Paraguay offer the clearest paths in the Americas, and Hong Kong and Macau serve similar functions in Asia. If you're targeting European Union access, Malta really stands alone. The €15,000 minimum annual tax under the Global Residence Program buys you non-dom remittance treatment plus full EU residency rights. If you want the absolute lowest rates, Paraguay's flat 10% local tax combined with 0 foreign tax and Mauritius's flat 15% tax on everything make up the global floor. If you're earning considerably above €150,000 annually from foreign sources, Gibraltar's £37,000 tax cap can make sense. If you need time to restructure before committing, Uruguay's decade-long holiday offers some breathing room. One critical warning here though, tax laws evolve constantly. Our IMI pros can tell you that. Thailand's 2024 remittance restructuring and Uruguay's proposed threshold increases demonstrate how quickly frameworks can shift overnight. Professional guidance isn't really optional here. That's why we built this network of professionals at IMI Daily to help you through the planning and implementation. If you're more focused on Europe and how to achieve a better lifestyle while also paying less in tax, we've got you covered. Check out the video on your screen now for an expert-informed guide on 13 low-tax regimes in high-tax Europe and the immigration programs, investment and non-investment, that will help you move there with ease. See you in the next one.